Global stock markets are now in a precarious position. A great deal is riding on the fate of just a handful of companies and one country. In this video, we'll outline 4 triggers that individually or combined could lead to a stock market crash. And finally, what should you do with your investments if it looks like these triggers are likely to happen? Today's video is sponsored by Ramin UK, the free, easy-to-use online savings marketplace. What makes the current situation so precarious is that we've got a risk amplifier, which is that we're all in one trade. Now, you'll often hear about analysts talking about concentration or positioning. What that actually means is that if everybody's in the same trade, then if there is a reversal, everyone will be stampeding out at the same time, and you can get very severe and rapid falls in markets. Now, I'd say what characterizes the current equity market is that essentially we're all in one trade. To see what I mean, let's take a look at a developed market fund. And this fund tracks the FTSE Developed World Index. Now, if you look at the top 10 holdings of that fund, you'll see that they make up a quarter of the overall allocation. And that's despite the fact that there are over 2,000 stocks held in the fund itself. Now, that is unusual. What's not unusual is for the US to dominate global markets. That's been pretty much the case over the last century or so. But this concentration in just a few names, that is unusual, certainly when it's concentrated to this degree. And to illustrate that concentration, let's look at the market capitalization of those magnificent 7 stocks which dominate the US market. And you can see that their combined market capitalization exceeds that of many different countries. It exceeds the entire stock market in Europe, for example, and it's much larger than Japan, India, the UK, France, and so on. In fact, if you just look at the change in market capitalization since January 2023, that's actually about 4 times the market capitalization of the entire UK market. The reason why that concentration is risky is that if one or more of those companies disappoint on their earnings, or maybe their entire industry suffers a setback, then your seemingly diversified global index fund will suffer a big setback. Or in other words, we're not as diversified as we think we are. Now, because of that concentration, I think it's useful to think about the triggers which could cause a reversal in the fate of the global equity market. So that's what I'm about to try and do. And we'll start off with number 1, which is US economic weakness. Now, at the moment, the US economy is strong. It's got above its usual level of growth and things seem to be okay. But it's always good to look out for forward-looking indicators, or at least coincident indicators, which tell you what's going on right now. Now, a useful one is called the surprise index. This is created by Citibank. Now, what this does is to look at economic indicators in the US or elsewhere as they're published. And if they beat expectations, that pushes the index upwards. So that's a positive surprise. If they fail to meet that expectation, then that's a negative surprise. And then the cumulative positive and negative surprises are added up, and we come up with a surprise index. The economic indicators that go into it would be things like GDP growth, employment, inflation, and consumer confidence, for example. Now, notice what's going on right now, which is a weakening of these economic surprise indicators for the US. Of course, these are measured relative to expectations, and expectations for the US are now pretty high. However, what this does show is that the disappointments are starting to creep up. Another thing which people look at are GDP Now forecasts. These are real-time forecasts of what's going to happen to the next GDP measurement. As each piece of relevant economic data comes in, which feeds into US growth, it's used to update these GDP Now forecasts. Now, there's been a lot of discussion recently about the one from the Atlanta Fed, which is showing a very severe drop, and that's for the Q1 2025 GDP number. In fact, as you can see, it's falling off a cliff. The estimate for March the 3rd was a 2.8% fall for US GDP. Now, what led to that weakness? Well, various factors fed into it. For example, weak consumer spending in the US, a wider trade deficit, and a surge in imports as companies try to get ahead of the tariffs. For example, if you're importing aluminium, you'll try and get as much of it into your company, into your warehouse, before the tariffs kick in. It's also due to the timing of data releases, because what you would expect is a surge in consumption or investment that goes with this increase in imports. And the trackers don't have access to this inventory information yet. So probably it won't be as bad as this, nowhere near as bad when we get those inventory data, but still it is worrying. Another thing which I think is useful is to look at what bond markets are expecting. Now the long end of the curve, from about 10 years outwards, is based on growth and inflation expectations. And in fact we can separate out the two. When we do that, you can see that the inflation expectations really haven't fallen much at all. What has fallen is the real growth expectation. Now that's not a good look for the United States. It doesn't mean that the bond markets are right. It may be wrong what they're forecasting, but it certainly seems as if the bond markets are pricing in weaker growth ahead. Now of course the US doesn't want this to happen. All of the presidential policies are geared towards improving growth. At least that's the idea. However, in practice, it may be that they fail to do what they're expected to. And I think it's fair to say that a lot of those policies are unconventional. The second trigger is economic uncertainty. Now you're probably thinking that sounds a bit of a woolly concept, but in fact you can quantify it. In fact, these two indicators which you can see, which you can download yourself from the Federal Reserve Economic Database, look at information from newspapers, and they look at the juxtaposition of words which indicate uncertainty with words which are about the economy. So you can see the top panel is trade uncertainty and the bottom panel is for general economic policy uncertainty. Now it's no surprise that the trade uncertainty at the moment is at very high levels. We haven't seen anything like it since the pandemic. And also for general economic uncertainty, that's also spiked to very high levels. Now notice what often happens is you get these grey shaded bars, which are US recessions, that go hand in hand with that uncertainty. Now there's not necessarily a causal relationship between the two, but it is worrying that we're getting this degree of uncertainty. So while it might be the case that unconventional economic policies could generate better growth, it may well be that too much unconventionality leads to a weakening of growth, and as we'll see in a moment, it leads to a severe weakening of growth globally. What would be the mechanism for that weakening of growth? Well, certainly if you look at something like the manufacturing survey in the United States, the ISM survey, that's recently been weakening. But what's really interesting is if you read some of the responses, it is a survey-based estimate after all, but these are actual responses from companies in the United States. For example, here's one from the chemical industry. It says the tariff environment regarding products from Mexico and Canada has created uncertainty and volatility amongst our customers and increased our exposure to retaliatory measures from these countries. And here's one from a company which produces transportation equipment. They say customers are pausing new orders as a result of uncertainty regarding tariffs. There's no clear direction from the administration on how they'll be implemented, so it's harder to project how they will affect business. So what's really happening here is that it's becoming difficult for these companies to plan, and that's also affecting the willingness to create new business if you're not sure what prices are going to be in the near future. So if this uncertainty persists, I think it's pretty clear that that's going to have a chilling effect on the US economy, but also more widespread in the global economy. This video is sponsored by Ramin UK, the no-fee online savings platform. If you're like me, you want to get the most from your savings. That's where Ramin UK comes in, a free-to-use marketplace that makes growing your money simple. Ramin UK offers access to a huge variety of savings accounts from over 40 FSCS protected banks and building societies. All in one place. No need to hop between websites comparing rates. They've done the hard work for you. You can find everything from easy access accounts to notice accounts to fixed term bonds with competitive interest rates. And the best part, it's completely free to use. Once you've registered, you can manage all your savings from a single dashboard. Simple, streamlined, and super convenient. At Ramin UK, all of the savings accounts offered are protected by the FSCS or European Deposit Guarantee Scheme, DGS. With FSCS protection, if you hold money with a UK authorised bank, building society or credit union that fails, you'll automatically be compensated up to £85,000 per eligible person per bank. What's more, for a limited time only, you can receive a £100 bonus when you register and fund your first savings account with a minimum of £10,000 using the code SAVINGS100. For more details, please visit the link below. The third thing to watch out for is a loss of credibility for the US government. Now, some of the things which we've heard out of the US government have been just bluster or irrelevant, like renaming the Gulf of Mexico, but some of it has been quite shocking. For example, when you get a US president who's giving tickers for cryptocurrencies which potentially could be included in a US reserve of cryptocurrencies. For example, here you can see President Trump in a social media message about XRP, SOL, and ADA. Now, these are potentially going to be included in that crypto strategic reserve, alongside Ethereum and Bitcoin, of course. And of course, that had a big effect on the prices of some of those smaller cryptocurrencies, a huge rally in fact. However, in the case of Bitcoin, the rally was fairly short-lived. But really the question you have to ask is, why does the biggest economy in the world need a cryptocurrency reserve in the first place? Is it because the dollar's not good enough? And why is the US president talking about single cryptocurrencies? Surely there are higher priorities for a US president which are based on the economy or trade perhaps. More worrying still is when the US president starts talking about annexing an independent country in its northern border, Canada. Here he's talking about how Canada probably wants to become the 51st state. However, it doesn't seem as if Canadians are keen on the idea at all. These kind of statements, in fact, I think just make the US look ridiculous. Even more worrying is geopolitical instability. Now, you probably saw this press conference where President Trump and Vice President Vance were talking to Zelensky of Ukraine. And it was a train crash of a press conference. You really don't expect to see world leaders pointing at each other and shouting in front of the world's press. And then following this press conference, the US cut off aid to Ukraine altogether. A White House official said the president has been clear that he's focused on peace. We need our partners to be committed to that goal as well. We're pausing and reviewing our aid to ensure that it's contributing to a solution. However, cutting aid to Ukraine is actually what Putin, the invader of Ukraine, wants. So it's quite difficult to see how this is actually contributing towards peace. In fact, by trying to push rapidly towards an ending of hostilities between Russia and Ukraine, it may be that Trump's actually playing towards Putin's goals. In fact, you could argue that Putin is getting what he wants. He invaded Ukraine, and now the US president is siding with Russia, it seems, against Ukraine. In fact, if you look at a map of NATO countries, remember NATO was set up to try and oppose the expansion of the Soviet Union, you can see that a lot of countries which have a large border with Russia, countries like Finland, Latvia, Lithuania, these countries are probably worried that support from the US is not reliable. If they're invaded, what would Trump do? Now, of course, the idea behind NATO is that an attack on one country is an attack on all countries, and that they'll fight off the invader. But it seems as if the current move in political circles in the United States is to weaken those global guarantees. And I think that makes for a more risky world. And it's not just Russia that could be emboldened by this approach of the US president, it's countries like China, which are probably watching very closely. Now, the map you can see here is what's called the 9-dash line. This is the region in the South China Sea which China claims is part of its territory. Notice that it includes Taiwan, but it also includes the Paracels, the Spratlys, and other islands nearby. So perhaps China too will be emboldened by the seeming success of Russia's invasion of Ukraine. I think another side effect of populism gaining ground in the United States is that these ideas could spread to other countries. We've already seen it to a large extent. In fact, we're already seeing that in Europe, for example. Now, the beliefs that go with this populism would include things like being against free trade, more protectionism, which, as we've seen, could be a problem for global economic growth, Also, as we've seen, a weakening of mutual defence and sovereignty may not be considered so important, or at least, to put it another way, if a country's small enough, its sovereignty just doesn't matter. Another aspect of populism is a fondness for authoritarian leaders, and Trump's fondness for authoritarian leaders is no secret. Even more worrying for the United States, given its historical success in the sciences and technology, is a shift from science to folk wisdom. An example of that would be the appointment of Robert F. Kennedy as US Health Secretary despite his anti-vax views. Another example would be dismissing ideas about global warming despite the overwhelming evidence that it's real. And another view that's often shared by populists is based on anti-immigration, even if that immigration is good for growth. So if these ideas spread and they become ingrained globally, I think that could have a chilling effect on the global economy, and it'll affect markets negatively. Because while it is possible to gaslight your populace with false claims, you can't fool nature and you can't fool markets. The simple fact is that if corporate profits fall, stock prices fall as well. The last trigger would be a global economic slowdown. Now, the result of all these tariffs and counter tariffs is to make trade much more expensive and to push up inflation. And it'll have a weakening effect on growth. Now, that won't just be a US, Canada and Mexico problem, it'll become a global problem. And that's because the global economy is highly interlinked. So the longer these tariffs last, the more widespread they are, the larger they are, the more it's going to negatively impact global growth and, of course, the stock market. And that's because profits, corporate profits, rely on that lifeblood of trade. So those are the triggers I see right now for a global equity sell-off. What should you do about it? Well, this all sounds very bearish, and I don't want to create a sense of panic in your mind. Remember, most of the time, markets recover from things such as these. If you are still in the savings part of your investment career, then steadily investing into global equity still makes sense. And that's because you can look through this period of volatility, and in fact, if equity markets sell off, you're buying at lower prices, which increases your long-term return. In that sense, a crash is good for you. However, if you are close to retirement or already in retirement, or if you've got a large lump sum to invest and you don't want to put it all into the market during these periods of instability, then maybe you should think about being more cautious. Certainly, if I had a large lump sum to invest right now, I wouldn't put it all in one go. I'd space it out over, say, 12 months. And I've also got previous videos about lump sum versus drip feed investing if you're interested. But the most important thing is if markets do crash, don't sell your equity. That's the worst thing you can possibly do. Even things which seem very severe at the time will eventually get better and equity markets will recover. The real problem happens is if markets fall, you sell, and then markets bounce back, you'll have realized that loss and you won't participate in the upside that follows. So what I would say is don't panic. Everything eventually will get better, but I think we are going through a period of economic uncertainty, but also market uncertainty, and I think sell-offs are not unlikely in this environment. Now, don't forget the offer from the sponsor of today's video, which is Raising UK. You can receive a £100 bonus when you register and fund your first savings account with a minimum of £10,000 using the code SAVINGS100. And you'll also find details about that and a link in the description below. And, as always, thank you for listening.